As many of you know, the FASB and IASB are in the process of finalizing their joint revenue recognition standard. One of the industries that may be impacted by the new standard is the power and utility industry. I'm Scott Heiser, a senior manager in KPMG's Department of Professional Practice and a part of the revenue recognition topic team. This podcast will provide you with a high-level summary of the forthcoming revenue standard and highlight some impacts the standard may have on power and utility companies. Let's start with a brief overview of the model. The new revenue standard includes a 5-step model for recognition of revenue from contracts with customers. Those 5 steps are highlighted on this slide. In step 1, an entity determines if a revenue contract exists based on the criteria in the new standard. Additionally, an entity will need to consider whether a contract should be combined with other contracts. In step 2, an entity determines how many units of account or separate performance obligations are in the contract. In step 3, an entity determines the transaction price. This includes estimating variable consideration and determining whether the constraint applies. An entity would also need to account for any significant financing component in the contract. Once the transaction price has been determined, the transaction price is allocated to the performance obligations. That is generally done on a relative standalone selling price basis. The 5th step is to recognize revenue when or as the entity satisfies a performance obligation. Each performance obligation is evaluated to determine if it is satisfied at a point in time or over time. If satisfied over time, the entity will need to determine an appropriate measure of progress towards satisfying that performance obligation. If satisfied at a point in time, the entity will need to determine the point in time when control transfers to the customer. Now I'll discuss some of the potential changes for power and utility companies from the new revenue recognition model. Under the forthcoming standard, if the goods or services promised represent a series of distinct goods or services that are homogeneous and meet both of the following criteria, they would be treated as a single performance obligation. Each distinct good or service in the series that transfers consecutively to the customer is a performance obligation satisfied over time, and for each performance obligation in the series, the same method is used to measure progress towards satisfaction. Power purchase agreements, commonly referred to as PPAs, typically give power companies the right over the term of the contract to bill a customer monthly for a fixed amount of capacity in exchange for a fixed price and/or fixed or variable amount of energy consumed, which may be based on a fixed or variable pricing. When PPAs are not accounted for as a lease or a derivative, which are outside the scope of the forthcoming revenue standard, power companies may conclude that these PPAs are single performance obligations satisfied over time and an output method of measuring progress toward complete satisfaction of the obligations is appropriate. When power companies have a right to consideration in an amount that corresponds directly with the value to the customer of the performance completed to date, it may be able to recognize revenue in the amount to which it has a right to invoice. Another potential change for power and utility companies relate to contract modifications. PPAs are often modified by extending the initial term while concurrently adjusting the price prospectively for both the remaining initial term and the extension period. Under the forthcoming standard, when the pricing is modified for the remaining initial term, the contract modification may relate to a performance obligation satisfied over time that is partially satisfied. In these situations, the transaction price and the measure of progress for the initial term and extension period are updated, and previously recognized revenue may need to be adjusted on a cumulative catch-up basis. PPAs frequently contain fixed escalator clauses that increase the price at predetermined rates and times. When PPAs are accounted for as a single performance obligation satisfied over time, power companies will need to determine the total consideration to be received and recognize revenue using a measure of progress that best depicts the transfer of goods or services to the customer. This may result in a straight-line revenue recognition model based on the total contract price inclusive of future price escalations, which would change current practice because contractual price escalators are contingent upon future delivery of energy and generally are not recognized until effective under current practice. Power and utility companies that sell renewable energy credits, also referred to as RECs, in conjunction with selling power, will need to assess whether the RECs represent distinct performance obligations. This will require consideration of whether the recs are highly dependent on or highly interrelated with other promised goods or services, such as the delivery of renewable energy. If distinct, the consideration is allocated to each performance obligation on a relative standalone selling price basis. If not distinct, the consideration may be attributed to a single performance obligation satisfied over time as power is delivered. Finally, another matter to be considered as part of adopting the forthcoming standard relates to sales of real property. Although typically not part of their ordinary activities, when selling real estate, power companies will use the forthcoming standard to determine the existence of a contract, the transaction price, including the constraint, and the timing of transfer of control. The effective date for public companies applying U.S. GAAP will be for periods beginning after December 15, 2016, January 1st, 2017 for calendar year companies. Early adoption will not be permitted. Under IFRS, however, early adoption will be permitted. Non-public entities applying U.S. GAAP will have a one-year deferral to 2018 for a calendar year-end company, although non-public entities can adopt in 2017 using the public entity effective date. The somewhat lengthy time between issuance of the standard and the effective date gives entities time to analyze the impact of the standard on their operations and financial reporting practices, design and implement systems, processes, and controls needed to implement the standard, and communicate the expected impact of the standard on the entity's financial reporting to key internal and external constituents. Entities will be allowed to select from three different transition approaches. First, there's a full retrospective. This is where an entity would recast all contracts for all prior periods presented in the financial statements. The second approach is like the full retrospective approach, but uses one or more optional practical expedients provided in the new standard. For example, an entity would not have to recast contracts that began and ended in the same year. And finally, there is the cumulative effect at the date of adoption approach. Under this approach, an entity would not restate prior periods, but instead would record a cumulative effect adjustment at the beginning of the year of adoption. So on January 1st, 2017 for a calendar year-end public company, and provides disclosures in the period of adoption of the impact of the change of each financial statement line item. This means that under the cumulative effect approach, an entity would have to account for revenue transactions both under the new standard and legacy GAAP in the year of adoption to determine the effect of the accounting change in the year of adoption. We plan to have additional podcast, webcast, and thought leadership publications to keep you updated on the new standard and related implementation issues. You can also find our latest information about the new revenue recognition standard and other financial reporting issues on our financial reporting network, which you can access at kpmginstitutes.com.